on the stock side of things with Chris Conway. He's joining us from Australian Stock Report live from our Melbourne studio. Chris, great to have your company on the show today. Let's kick it off just with the session first up before we get into some of those production numbers. What do you make of the surge we're seeing today, up about 1.1%, all sectors in the black?
Yeah, look, it's a great rebound from what we saw yesterday with the market selling off. Obviously on the back of the solid leads from US markets overnight. Interestingly though, it's more about now where the market is placed. We think we're in a bit of a distribution phase for the market at the moment. There's certainly some evidence in terms of stretched valuations and even technical patterns like triple top formations to suggest that you know, the bullish sentiment that we've seen recently has returned to equilibrium, and the bulls and the bears are now really slugging it out for supremacy, with neither party able to gain the upper hand. So yeah, in terms of today, like I said, great to see some green on the screen, but we've seen that pick up in volatility, and like I said, in a bit of a distribution phase for the market at the moment, we think.
Yeah, certainly when we see jobs numbers out today, that could sort of create a different direction for trade, right?
Yeah, absolutely. So, look, we're expecting that around 20,000 jobs will be created, the unemployment number to remain steady at 6.3%. Of course, if those numbers disappoint, that adds to the case for the RBA cutting rates, and that's one of the catalysts that we think could snap the market out of its funk. So, yeah, definitely if the RBA cuts rates, that will again fuel the yield play. That will probably push us above 6,000 and provide the next leg up for the market. But, you know, it depends on what the numbers look like today. And, of course, CPI numbers next week as well will also feed significantly into the RBA's decision.
All right, want to talk Fortescue. Got to get straight into that because those production numbers, of course, released today. The stock's surging up close to 7% right now. What did you take out of these numbers? Because obviously it cut its production costs. That's always welcomed. Also increasing shipping in terms of its guidance. So that's interesting to see, given the fact that the comments it's made, the commentary it's made around BHP and Rio. What do you make of the numbers?
Yeah, look, I mean, we actually didn't mind the numbers. It was all about cash costs for Fortescue. They managed to rein them in, and they provided some good outlook out to 2016 in terms of reducing those cash costs further. So that's obviously part of the reason why we're seeing the stock significantly higher today. The other factor, of course, is the fact that there's a good old-fashioned short squeeze going on because there were so many people that were short Fortescue and they're rushing for the exits as the stock surges higher this morning. It could end up closing up on the day by 10%, but look, the overarching story there is still iron ore prices. In previous weeks on the show, Ingrid, you probably remember I've discussed the fact that the supply and demand equation for iron ore is completely out of whack. There's far too much supply, not enough demand, and our expectation is that iron ore prices will continue to head south. So a good day for Fortescue today, but the longer-term story remains questionable.
Do you think it gives investors, though, some solace at least that the business can continue to break even, you know, just in light of what we've seen, obviously, from Atlas Iron and some of the shuttering mines?
Yeah, certainly. Look, we perhaps haven't been as bearish on FMG as some other analysts, and the reason for that is, look, Fortescue has spent so much time bringing production online. That's been their primary focus to ramp up to their goal of, I think it was 155 million tonnes per annum was their initial goal. In spending so much time and energy trying to obtain that objective, they haven't really focused on efficiency so much. Now that they're starting to do that, we've seen the cash costs come down. They've said that they can bring them down further. And as they focus on that, the expectation is that they will. So yeah, it absolutely provides some solace for investors, and we would believe that they can continue to bring those cash costs lower. The problem, of course, though, is if the iron ore price chases those cash costs lower, again, it just kills the margin anyway. We've
seen a couple of offers and opportunistic offers for mining services firms throughout this period, of course, of plunging iron ore prices. Do you expect to see more consolidation over the coming 6 to 12 months, even further out from that? You know, just seeing a lot of analysts obviously cut their forecast for iron ore for the next 3 to 4 years.
Yeah, so consolidation in the iron ore space, yes, possibly. One of the things that concerns us, however, is that there's really no M&A activity or discussion going on in the iron ore space that we can see. Now, traditionally, when big producers think that the bottom of a price cycle is near, they will tend to look for M&A deals. We saw that recently with Shell acquiring BG. You know, they're the best makers of the price, being the producers. They're seeing what's going on in the ground, but there's just nothing happening now in that iron ore space. So yes, it probably still will come, most definitely. But the worry with not seeing that M&A activity is that perhaps these big players don't think that the floor for iron ore prices is anywhere near at the moment.
I want to talk about Iluka as well, just looking at that mineral sands producer and its numbers today. Look, it's off by about 4.8%, but we've got to say it's had a pretty good run so far this year.
Yeah, look, the numbers today, there were no surprises from where we sit. They were pretty much in line with the company's expectations. I think what investors will be worried about there is the patchy zircon sales. Of course, that's all tied to construction in China, which we all know has slowed down. There's not as much demand, and of course, like I said, that demand for zircon is patchy. So with that patchy outlook, investors selling the stock off today. I think before I left for the studio, it was down around 4.5%. So yeah, still struggling there.
Just in terms of looking at the market today, you know, we're at 5,964. We haven't quite breached that 6,000 level yet, although we've come pretty close. It's almost becoming a technical level, even though, you know, it has traditionally been more of a psychological one. Where are you seeing value in the market right now? Do you have any views on sort of where to buy into?
Yeah, absolutely. So, look, we're looking for companies that have strong balance sheets, comparatively little debt, and I think most importantly for us is a competitive advantage. So, names like Select Harvests, Green Cross, Premier Investments, which, again, I've talked about on the show previously. They had some good numbers out about a month ago. They're the names that we're looking at. So, yeah, it's tough to find value in this market. You know, compared to historical averages, the forward PE is higher than it's been in the last 20 years. So finding value really is tough, but it's companies with competitive advantages that we think are the best places to park money at the moment.
Do you like the energy space right now? I mean, just given the surge we've seen in oil prices of late.
No, energy for us is still, we don't quite have enough evidence there just yet to suggest that we're going to see a consistently higher oil price. That's really the caveat for us. If we had more evidence to suggest that that was the case, we'd be more inclined to look at the oil plays, but there's just not enough evidence there. We think oil prices will remain volatile, and we think there's probably stronger investment propositions out there at the moment.
All right, Chris Conway, we'll leave it there. Thank you so much for joining us.
Thank you.